Real estate syndication can be an easy transaction between a sponsor and a set of investors. Overall, this is a win-win situation for all the parties involved and could lay the foundation for syndicating additional deals later on. You understand how when two guys open a bar together, one has extra money to take a position and one other has a whole large amount of experience working in and managing bars? The guy with all the bar experience, the sponsor, finds a bar to start and arranges everything, whilst one other guy, the investor, just frees his money. The guy with all the bar experience naturally runs on the bar, and, as a consequence, receives a paycheck for his work. Both receive a share of their proceeds based in time and money. Real estate syndication can be an ideal way for investors to pool their own financial and intellectual resources to buy real estate and projects much larger than they can afford or manage by themselves. You are going to have to constantly guarantee that the residence is managed and operated economically by communicating regularly with the home manager. In case the residence is undergoing renovations, it'll likely soon probably be your job to be sure that the renovations are completed and under funding. Many investors that stay away from real estate achieve this because liquidity is key to their own. They enjoy the freedom to get and sell when as they see fit, and view real estate as an expenditure decision type that protects their capital for a very long time period. Nonetheless, liquidity may be your number one reason why several investors decide to speculate in the stock market and maybe perhaps not enter into real estate. In a few cases, the host could have the privilege to deny the sale of their bar's shares. Bear in mind, the host vets investors precisely exactly the same way investors kitty patrons, and so they want to understand who will function as the new partner. Their decision might possibly be based on a variety of reasons, however, the most important thing could be that the host makes your choice. After each investor receives a favorite return, the remaining money is spread between the sponsor and the shareholders based on the syndication's profit divide arrangement. Thus, using an 8% preferred rate of yield and a 50%-50% divide, your investors will have made $80,000 at interest and another $20,000 out of its own equity participation from the cash flow from the land. That might equate to a 10% cash-on-cash yield for these, plus, they still have an equity percentage within the appreciation of their property. Therefore, there's still an option to allow them to make more money in the back end, when the land has been refinanced or purchased. Let us say that you and a set of investors acquire a construction for about $1,000, all cash, no mortgage. Your investors set up the amount, which comprised your acquisition commission. After all the expenses have already been paid, for example your asset management commission, the land generated $120,000 a year in profit. Your creditors will generally be eligible for a favorite interest payment. Let us assume that it's a favorite interest rate of 8%. That means that the shareholders will get $80,000 in interest out of that $120,000 profit, 8% of 1M. The remaining $40,000 will be divided between you and your shareholders at whatever percentage you agreed upon. That would possibly be a 50% divide, or it is actually a 75%, 25% divide, becoming the larger percentage. Another way to find out the purchase cost is always to calculate the total yield within the stated grip span, and prorate the share price based on the year by that you want to market your shares. As the manager and operator of this deal, the sponsor frees the sweat equity, for example scouting outside the land, raising capital and acquiring and managing the expenditure land's day-to-day operations, whilst the shareholders provide the majority of the financial equity, rental revenue and land appreciation. Back from the Dark Ages, aka pre-online, real estate syndication demanded that curious investors have an established system of syndicate partners to locate trustworthy and profitable deals to purchase shares of. Equity participation, cash flow and appreciation. Finally, you're going to soon likely probably be compensated throughout your equity participation from the job. Your equity stake from the job will range anywhere from 5% depending upon your own experience and also the details of the deal. Normally, your investors are going to be given a preferred rate of yield ranging from 8%, 12% or even maybe more, in an invested capital. Then a remaining cash flow and/or equity is going to be divided between you and your investors at whatever percentage that was agreed upon. In case you are a passive investor that invests $50,000 at a deal using a 10% preferred return, then you might take home $5,000 each year once the land earns enough money to make payouts potential. If, as an example, the profit divide arrangement is 70-30, traders internet 70% of their earnings after receiving their favorite returns and also the host sheds 30% after preferred return. Here is an example: after everyone receives their own favorite reunited a 70-30 deal, and there's a 1 million remaining, shareholders could get $700,000 and the sponsor would get $300,000. The very ideal thing to do will be always to ask the syndicator directly about their approach to attempting to sell investors' shares. Another source will be your private placement memorandum, PPM, that you register up when making an expenditure. This is a legal record, demanded by the SEC, and comprises the partnership agreement. The PPM also summarizes all of the information about the job the host and shareholders are compensated, commission arrangements, yields, and the way the rental revenue and appreciation is going to soon likely probably be distributed. It also contains information about the circumstances by which an investor can sell their own shares as a result of hardship. Most investors feel that means that their money is going to be secured in for 5 to 8 years, and come to really feel uncomfortable with the lack of access with their own money for such a long time term. This can be a major misconception in regards to purchasing a syndication. Once you purchase a house at a syndication, then you are part of a set of investors that all own shares of an LLC that owns your property. Thus, technically you have the ability to promote your shares even and on occasion to shareholders from the category to an investor that wasn't part of their original category. Passive investors frequently have the misconception that their money is going to be tangled up throughout the full grip amount of a multifamily syndication deal. The reality is that many patrons allow investors to sell their own shares. When an investor wants to leave ahead of this property's sale, the procedure has to be stated from the deal's private placement memorandum. Investing at a syndication deal that allows you the flexibility to market your share at any moment unites the advantages of buying the stock market with all the advantage of owning real estate. The very fact could be that the investment's bandwidth is determined by the syndicator. There may be cases where an investor or her family was engaged in a severe accident, became ill or had a similar kind of hardship, and so they desire cash. Even the syndicator may allow the sale of shares in certain cases, however, maybe perhaps not all. As a passive buyer, your homework will consist of asking whether the syndicator allows investors to sell their own shares and just how easy could it be. Acquisition charges. As a syndicator of real estate, you may typically receive compensation for choosing the home, conducting research, and simplifying the deal. Acquisition fees can range anywhere from 1% to 5% of their acquisition fees, or it can become a flat rate, that is $25,000. These fees are generally negotiable with all and other shareholders that you bring in the deal. If your prices are too much, shareholders may possibly be leery to take a position together with you personally. Finding and structuring deals can become a tedious task, so make certain that you are compensated for the time and energy. Very long story short, crowdfunding brings real estate syndication into the relaxation of one's living room and the capability of one's tablet computer or PC. The greatest misconception: lack of liquidity in syndication. Crowdfunded real estate syndications are somewhat more accessible, have lesser investment minimums, and give a wealth of internet job information available to potential investors. An example: the sponsor is usually accountable for investment anywhere from 5–20% of their total necessary equity capital, whereas traders placed in between 80–95% of their total. Hopefully, This article was really helpful and provided you with greater insight regarding what you can benefit from syndicating real estate agent. For those who have any questions, then we can carry the conversation finished into the opinions below. Therefore, please allow me to know your thinking and comment below. So when and how will everyone get paid back? Payment is contingent on the period the investment should mature. A few kinds of syndications are over within 6-12 months, while some can take 7-10 years. Everyone who welcomes receives any share of their proceeds. Many passive investors have the misconception that if investing into a syndication, their money is going to be tangled up through the whole grip period. A hold span could be the amount of time that you simply just hold on tight to this property after buying shares at the LLC that owns the construction. The time frame is usually measured in years, and the majority syndicators contain the land for 5 to 8 years. As the syndicator who had been able to participate in a deal with minimal money away from one's personal pocket, and you also could have now already been paid through an acquisition fee, asset management commission, and an additional $20,000 in cash stream. You are still going to have a 50% stake in any prospective equity appreciation from your property. Syndications are easy to establish and develop with built-in protections for all parties. They are usually ordered as a limited liability company or a restricted partnership together, using the sponsor participating as the general partner or manager and also the shareholders participating as limited partners or passive associates. Sponsors netted a land management fee between 2 and 9%. The average favorite reunite was 8%. In addition to managing the investment, then you'll also be accountable for managing the syndicate. This obligation will probably need that the investors are communicated using over the regular basis in regards with their own investment and ensuring that they receive their compensation on a regular basis, that is yearly, quarterly, or whatever time frame that was agreed upon. Bankers received a favorite reunite ranging from 5-10%. When the PPM has a supply to an early sale to another buyer, and the host could probably allow a hardship sale of your shares, just how would you cost them since the land hasn't sold? It's hard to calculate, because a fantastic part of the investment yield is based on appreciation at that time of sale, and you also can't accurately state the amount of appreciation in case you sell your shares early. Crowdfunding can be a way to raise money throughout the web for a significant project with the assistance of an audience of investors. Even when a job becomes enough funds, it's a move, and when not, the more money can be returned to investors. Summary: rental income by a syndicated land is spread to investors by the home based to a monthly or quarterly basis according to predetermined terms. A house's value usually appreciates more than, therefore investors can net higher rents and earn larger profits once the property comes. The way to price your shares. The very ideal approach is always to take a look at the return projections summarized at the start of deal. Another approach will be to take a look at the average returns to get a multifamily property. By way of example, cash-on-cash returns average from the 68% range. However, if you should be departing the deal early, that number may have to become adjusted. Real estate syndications are ordered in order that the host is motivated to guarantee the investment works well for everyone. Let us look at an example of a return. Much like the two guys opening a bar, with the guy with all the bar experience had to meet with the guy with all the money, and vice versa. Before a sponsor shares from the proceeds for their job as manager and promoter, all traders receive exactly what is called AL, that is favorite asset management charges. Another way to make money from real estate syndication would be to get an asset management commission. This commission, generally 1% of gross sales, is typically paid for you as the syndicator of this job, because it's going to become your responsibility to manage not just the home but also the syndicate partnership as well. On another hand, some PPMs indicate that the investor can sell their own shares without any constraints. As a syndicator myself, I opted to provide investors the ability to offer their own shares at any moment as a way to allow them flexibility by using their money. I actually do so because I feel it creates a flawless platform that unites the potency of owning real estate with the flexibility that the stock market